Hello and
Hello.
welcome. My name is Everardo Gomez, and I am a managing director at Hump Capital. I help companies find debt, and I'm very excited today well, before that, let me read my disclaimer. I'm not actually a registered representative or investment advisor, representative of ICM Capital Markets. So all of the conversation related to investment products or services that are offered by us during this conversation are not investment advice. Please contact me and I will direct you to a registered representative of our FINRA broker dealer with any questions. With that out of the way, I'm very excited today because we have Mark Baker of Thymiya Capital, Mike Togi, former president and CEO of Clarity Software, and Rick Brookshill, co-founder of Goldpan. I will start with a couple, letting them introduce themselves. So Mark, can you give us a quick background on yourself?
Yeah, thanks, Everardo. Hi, everyone. Mark Baker here. I'm the VP Marketing at Thymiya Capital. We provide mainly B2B SaaS companies with debt. So non-dilutive capital, $1 to $5 million checks to B2B SaaS companies between $2 and $20 million.
Great, thanks. Mike, can you give us a quick background?
Oh, you're on mute, Mike.
Thank you. I was on mute. So Mike Togi, been a CEO at a few different companies, founder in 5, raised approximately 40 million in funding across those 5 companies, and was either the CEO or reporting to a CEO. 3 of those have now exited. 1 is still running on its own, and 1 didn't make it. So some success and some failure. And for most people, that's in the sort of SMB tech space, that's what you need to be successful, in my opinion.
That's pretty amazing. Thanks. Rick, can you give us a quick background on yourself?
Absolutely. Well, thanks for having me today. Well, currently I am co-founder of a company called Goldpan, and Goldpan provides managed win-loss to technology companies. Can dive into that a bit later, but background as entrepreneurial, I started in elementary school selling firecrackers to other kids in the school ground, undercover. Had landscaping companies, retail companies, and then did some kind of grown-up things for a bit. Went into technology in about 2000, have been there ever since. Primarily helping founders, either as their COO or CRO, helping them scale their companies, pivot their companies. Have had 4 exits along the way, 2 of them to strategic enterprise companies. So it's been good. I've worked with Thymiya twice along the way, as well as other non-dilutive capital providers, and also raised a number of equity rounds along the way. Thank you for having me, and excited about this conversation.
Awesome, and what a great segue. Mark, can you dig in a little deeper on Thymiya? What is it that you guys do? I know you told us briefly, the check size, but what is it that a company is looking for when you guys get involved?
Yeah, absolutely. Thanks. So being non-dilutive, we primarily will target companies that are either capital efficient or lightly capitalized, so bootstrapped, or have done small raises. And really the primary goal of our capital is growth. And we look at kind of 4 different ways that companies do that. So we're a bit of a hands-off lender. So we like to deploy the capital and let the companies run based on their plan. So the first one really is growing your valuation. So this is like pushing off a Series A or replacing a Series A. That's where we have quite a strong fit. And there's some examples of that. Possibly pushing off like an exit. So that's primary reason number 1. Number two is really scaling sales and marketing, and that's kind of parallel to the first reason. But it's kind of surprising how many VC dollars get spent on Google ads and Facebook ads. And so if you figured out kind of a flywheel of your marketing or sales teams, then why do you need to raise equity dollars to do that when you could do that with debt? And so we'll do on average like 6 months of your current monthly recurring revenue in debt, and up to 12 months. We think that's a healthy amount of debt in the business where you can actually hire people, invest in your teams, and see a payback on it. So that's reason number two. Number three, we get a little bit more flexible. So cleaning up your cap table. So maybe you have some existing investors that have been there for a long time. Maybe you have a co-founder that hasn't been involved in quite some time, and you see an opportunity to buy them out early before, let's say, a larger raise or an exit. Or maybe you want a couple more years in the business, running the business before you make that activity. And so taking out debt, a lot cheaper compared to equity to clean up your cap table, or even recapitalizing. So you might have existing debt in the business that maybe it's too expensive, maybe brought it on early, and you want to stretch that out. So we have like an interest-only option of up to 3 years. So you're not paying any principal payments for 3 years, and perhaps your existing lender is calling the loan and you want to push off those principal payments so you can invest your cash flow back into those things that are working. And then finally, where we get really flexible is the fourth reason is doing acquisitions. So we can help companies purchase smaller companies or competitors, et cetera, in the space. And we can do all that actually subordinated as well. So if you're a larger company and you've been able to secure a senior line of credit, senior bank getting in there, we can stretch out a bit further, maybe 9, maybe 12 months worth of cash, and overall lowering your cost of capital. So really the trend here is that we are flexible, we can get aggressive, and we're trying to be really as transparent as possible. The founder of Tamaya, Greg Smith, has recently passed, and he always said, if you believe in your company, then why would you give away any equity when you could have debt? And so we strongly believe in that, taking that forward.
Oh, that's great. Thank you for that. A couple of questions. Geography. Are you limited by geography? And maybe this is for later on, but a lot of people talk about recurring revenue.
Yeah.
I think the definition has, let's say, expanded recently or lately. So those two things, kind of follow up on that.
Sure. So we are primarily in the United States, even though we're Canadian based. Most of our portfolio is US companies, and we do invest in Canada. So we're limited to North America at this time. And your second question is recurring revenue. So this is an interesting one, especially because of the growth of product-led growth companies, right? PLG. This often gets tied to usage-based pricing, and usage-based pricing tends to be more repetitive in nature than recurring in nature. And so just to cover off that real quickly, MRR is typically you're paying $1,000 a month every single month, regardless of how much you're using this software. Whereas a lot of PLG companies, or a lot of just repeat revenue businesses, let's say it's consumer focused, and you're buying like a meal kit, let's say. That's probably the easiest thing to refer to, but it's very common in software as well. You have companies processing a payment maybe in month 1 and maybe again in month 3 and maybe again in month 6. And so we're able to look at both. We got into this business because we felt recurring revenue wasn't respected as an asset, especially by banks. And we feel that entrepreneurs should get the credit, pun intended, that they deserve from that asset class, which is recurring revenue. And then as the market has evolved and as entrepreneurs have found new ways of generating revenue, we've also developed ways that we can have repeat revenue have similar respect. So we don't get as aggressive with repeat revenue. We're typically like 3 to 6 months worth of debt in a repeat revenue business or a repeat revenue business stream. And so that's where we get additionally flexible on those two types of assets.
That's great. Awesome. And I think there's a Q&A link on the webinar if people have any questions as we go along. Mike, tell us a little more about your company, your path, and previous companies with a focus on funding, non-dilutive, etc.
Got my mute button again there. I've sort of break this down into my career of raising money into sort of 3 rules. And one of my original mentors, and still a mentor, if anyone doesn't have a mentor, find a mentor. They're very useful. He always told me that you should always be trying to raise money. And if someone offers you money, you should take it. And he put that into my brain early on. And ultimately, I think with the variety of lending sources, the amount of lending sources, you should always be out there trying to find money. No matter if you don't need it, the best time to take money is when you don't need it, and at least have sources available. And I do agree with that in principle. It's always good to practice your vision, your strategy, your financials on people who you don't know, who are outside of your business. You're going to learn things as you go. And, that feedback is good, but the nuance is you should only take money that's right for your business. And so having a good database of those always on tap is, I believe pretty essential. So that's rule number 1 for any entrepreneur, any business owner. Get out there, start selling your business, try to find money. You're going to get feedback. They're going to get insights into your vision, and so on. So that's kind of my rule number 1. And I've done work recently with Tamaya. So we had a situation where we were a recurring revenue business. We're about $5 million at the time. We just closed the largest deal. It's about a $1.5 million deal with the city of Phoenix with that company. So we had to invest both in some of the execution of that deal, but that was a huge platform for us to grow our marketing and our sales. We'd largely been I like to say a bit quiet in the market in terms of sales and marketing until we climbed the hill all the way up to one of the top customers in the market. So that it was a situation where it was perfect for this debt financing. We had an equity owner who didn't really want to expand the net, but they also didn't really want to invest more. They were end of fund, end of life. And so that deal was a huge bridge for us, and ultimately it did lead to the sale of the company. So it was a perfect situation where we could bring on some debt financing, not mess with our equity structure, clear out some debt, and ultimately set us up for a more successful sale because it did clean up balance sheet and a number of things that market indicated. And ultimately that sale took us about 40 different presentations to find the right buyer. So that all that practice I had finding original lenders led directly into execution into the final sale of the company, which as an entrepreneur or business owner, for anyone on this call, it's just the type of discipline you need. And so that goes into rule number 2, always having a detailed plan around how you plan to spend money and how you plan to generate revenue is key. And your ability to be explicit and detail is very important. So The other situation I've been in, of the 5 companies, one was a recent sale, Aquatic Informatics. It ultimately had 2 exits. It was a founder-led company. I was the business founder. The tech founder was still with the company, and ultimately through 14 or 15 years of execution and friends and family, and so I've been through those rounds, ultimately sold to a PE. That PE only took 66% of the company, and then that transitioned to industry sale. So, what I learned through that stage of, very early stage, get a clear vision, figure out what you're displacing, lean on your friends and family. That is a thing, that is real. It still happens today. And then, keep selling, find an angel and an investor that believes in you. So your ability to sell your business, your vision, is paramount in any funding situation that you're in. So it's a bit of my history tied into a few of my businesses that I've been involved in.
Great. One quick follow up on that. The detail on your spend and your revenue. I mean, I know that that's very basic, but it's surprising to me how many really good companies I see that are looking for debt or any other funding, but they don't have a detailed plan on how they are planning on spending that that money, right? It's companies that maybe are looking for X amount, but they've never really had that amount to spend, right? Like you said, hey, friends and family here and there making ends meet, but now they're looking for a bigger pool, but they don't have a detailed plan. Can you, are there resources out there, or maybe partial CFOs or something, or how should companies and founders look at that, and so they can start planning ahead of that, and they don't have to do all this work the day they want funding, right?
Yeah. So I utilized in several situations. Obviously, I had a bookkeeping team, and people are running the payroll and all those types of things. Those are things I was not good at. That was not my skill. But the notion of a fractional CFO is a thing. There's resources where you can hire a very experienced technology CFO for a day, two days. Those types of people are going to come in and they're going to whip that plan into shape from an execution perspective. I think that's important from a financial forecast perspective, to have a 3 to 5 year plan that's fully modeled. Those types of things are are super valuable. But I mean, they're not going to figure out, how you're going to sell, what type of team, those types of things. That's got to come from you as the founder, use the inspiration, and to kind of set that up. And then when it comes to the sales and marketing, and that's where the Tamayas of the world are really going to want to see what types of people, what are their metrics, how many calls are they going to make a day, those types of things. In my experience, talked to 3 or 4 of the marketing automation platforms and the sales automation platforms, and they're going to give you frameworks for that, because ultimately they want to buy their software. So those companies are very good at providing frameworks to companies to figure out how to execute and build out what your plan might look like from a BDR, sales engineer, those types of things. I found that actually pretty helpful. And that was a little trick that I developed early on, was just talk to those companies a lot. I never actually bought one of their things, but the company that bought my last company did invest in that full revenue automation, and I was part of that execution ultimately. But they're pretty helpful in providing you a plan.
Awesome. That's actually a pretty nifty trick. Thanks. Rick, can you please go a little bit deeper into GoldPan and your background?
Great. Love to. Thank you. Mike, thanks for that tip about the sales automation companies. I'm going to use that going forward. So my background, I wish I had 3 concrete rules that Mike brought. I don't. Instead, I'll kind of talk through different stages of companies, because I have been through a number of different stages, from starting from scratch, as I'm doing right now with GoldPan, helping founders when they've had 4 employees, through to helping founders with 40 employees and growing those to varying sizes through to exit. I'd say I'm gonna lean off of GoldPan right now and more help the audience just understand different stages in the life cycle of a company. And early days, I think, Mike, you're absolutely right. Friends and family is a real thing. What you want to do is bet on yourself. Ideally, you have some of your own capital or friends and family capital that you can throw into efforts that you have conviction around. And once you are able to achieve some level of traction, it might be some level of product market fit, it might actually be some revenue, it could just be light professional services revenue. That's when you can start to think about additional outside sources beyond that family and friends network. The greatest, for the purposes of this conversation, the greatest asset you can have is cash flow. And let's translate that into MRR. So when we are talking about non-dilutive capital, as soon as you are able to show a level of recurring revenue, and really interesting conversation earlier around that repeat revenue. I actually had never made that distinction between the two, and maybe even lumped in some for you prior, Mark. But that's a very good distinction. So if you're able to have repeat or recurring revenue, then you're able to talk to folks like Tamaya and bring them to the table. If you have product market fit and not that level of cash flow or recurring repeat revenue, then maybe early stage equity is a more appropriate vehicle for you. But what I would encourage you to do is really, really along the way, consider how much of your company you are prepared to give up. And the advantage of non-dilutive capital is that you really get to hold on to ownership within your company and not give away too much. It is a far less expensive route to go than equity. And if you do, as Greg Smith says, have conviction in your company, why would you give away too much of it? So let's take that journey a little further. Let's say you have some cash flow. You can actually use non-dilutive capital in a number of ways, and I'll bring up a few of them. One is, and they mirror a fair bit of what Mark said, but I'll tie some additional experience in. One is most recently with Seven Geese, where I was brought in a lot later stage in the company, where the founder had done an extremely good effort bringing a market presence and a brand name to the HR performance market. And he wanted to do two things. He wanted to scale his sales and marketing and eventually use that as a jump off point to sell the company. And so we were able to partner, in this case, with Tamaya, and we were able to build a very strong case based on past historical results of how, if we added, in this case, approximately 30% additional account executives, how pulling that lever based on past experience would in turn increase our revenue and our MRR. We were able to bring in Tamaya, in part, actually increase our debt with Tamaya to be able to pull that off. And we were able to actually double our MRR based on pulling that lever of additional account executives. Our plan in that scenario was actually, once we got to that stage, to pay down the debt. Unfortunately, we hit something called COVID, and we had reached our goal and doubled our bookings on the year, but then COVID came. So that takes me to a whole nother scenario where non-dilutive capital becomes in a very, very important piece of your capital structure. And it could be equity too, but in our case, it was non-dilutive capital, where you need a strong partner that has patience and flexibility at the table. And in the case of Tamaya and others, that's what you are able to get. I did have one rule around COVID, to pull a page from Mike's book, which was I needed 3 times cash coverage of my expenses. Forget about any revenue coming in. I had no idea what my revenue is going to be. And I just simply needed 3 times cash coverage. So instead of paying down Tamaya, once we reached our revenue goals, was actually able to keep Tamaya in place, even with all of this uncertainty, with a good partner in Tamaya at the table. So that flexibility and that partnership and that conversation is also a really important part of any capital you bring in. So I'd like to emphasize that. Eventually, just this is an interesting tidbit, because I would imagine most of our audience here is looking at pivoting, scaling their companies for and potentially to hold long-term, but likely for an acquisition. This is the tidbit in this case is that we had planned to go to market, and we did go to market to sell the company. We hired a banker. We went hand in hand with Tamaya, and we had some light equity at the table, but primarily non-dilutive capital. And we were able to get 6 LOIs to the table with that increase in revenue. And then COVID hit. But with the patience of Tamaya at the table, we were able to hold on for another 6 months. 3 of those LOIs came back, and we added some additional ones for a very successful exit. Finally, I'm going to say, I'm going to double back on some words that Greg Smith, founder of Tamaya, had, which were, if you are confident in the offering of your company, why give too much of it away? There's always a time to give stuff away. But if you're extremely confident and you're in the right time, right place for the company, look at the outcome that our founder of Seven Geese had by virtue of not giving away too much in equity and leaning on non-dilutive capital. He had an extremely good outcome, and it's in large part thanks to partnering with Tamaya, and there's certainly others out there, but we had a great experience.
Awesome. Thank you very much. That was great. I have a couple of follow-up questions. One is for Mark. Do you require personal guarantees, and what is the minimum amount?
No, we do not require minimum guarantee. We do not require a personal guarantee. And our minimum amount, typically we look at 1.2 million ARR or $100,000 of monthly recurring revenue. That's kind of our floor. So the highest performing true SaaS companies with gross margins of 75%, we can get involved with at that threshold. Once you're past that threshold, let's say you're 2 million, 3 million of total revenue on the year, then we're able to get a lot more flexible. So at that point, you might have various different revenue streams, whether they be professional services, maybe your gross margin is a little lower because of onboarding, for example, especially if you're selling into, let's say, government or healthcare. It might take a lot longer to get your software integrated. So things like that. Just again, to repeat, we're typically a minimum $1 million check, but again, we can be flexible. So 1 to 5 million is typically our investment.
Great, thanks. And one for Mike. Which sales, marketing, revenue automation companies have provided the frameworks that somebody would need?
Marketo was one of them. HubSpot was another. I was also, my company was also developed and built on the Salesforce platform. So that obviously had a lot of insights into, just sales processes just by, the nature of being on that. But HubSpot was a good one. That's, of course, it's been a couple of years since I went through that whole process, but HubSpot was the leader. And then there was a whole series of tools we looked at that were more for BDR, calling stuff. I can't remember the names of those, but
Yeah, Outreach and
Outreach.io and sorry, go ahead. Mark.
SalesLoft.
Yeah, SalesLoft. Thank you.
Yeah, Outreach and SalesLoft have been very popular
Yeah.
with our portfolio companies.
Yeah.
Great.
So they'll help you out. And there's one other one. If there's a follow-up question, I can dig that up. We can send that out in the post-show follow-up. But I can get the tech stack that we used.
Awesome. Thank you very much. Appreciate it.
One follow-up, a useful little trick is, as we've just kicked off GoldPan, we haven't wanted to step up to having a full CRM in place. So we're operating with spreadsheets, as you do with a lot of things out of the gate. HubSpot actually has a download of spreadsheets that is a virtual Excel CRM and is very effective just for the out of the gate. A little bit tangential to the
and a follow up on that. I think if there's a company out there that doesn't currently do spreadsheets either, start using spreadsheets because that's going to get you into a process, right? Yeah. And if you don't have a process in place before you're talking to any marketing or sales automation, they're going to end up selling you the whole thing, right? So if you have a bit of a process in place, even if it's just using spreadsheets, that's going to help you pick a tool because at least you have a process.
Awesome. And then I wanted a quick follow-up on something that Rick mentioned that's, I think, very important is, I would say, the dance partner on non-dilutive capital too, not just on the equity side. And I think technology, and I've been in technology lending for some time. Also, it's a small sandbox, and so people will get to work with each other, as you guys have done in different startups. But I think, overall, the community behaves, I would say, in reasonable matters. But that, I think, a good point that you should do some background on your lender or equity provider, right? And everybody knows that from the equity side because you're going to be working with them for a long period of time, but also in your lender. It's quick, to do a quick kind of background and saying, hey, how's this lender behaved when things get a little sideways, right? I guess everybody has a lot of data points now with COVID, but regardless, it's always good to check. We have several follow-ups for Mark. Do you look at profitability in determining whether or not to approve the debt or the amount? I know you mentioned gross margins, right? But is profitability or burn or something like that, maybe initial liquidity? Tell me a little bit about that.
Yeah, great question. We actually can get quite aggressive on this stance. So we're looking at companies with growth rates of between 20 and 100% typically. Companies who are growing more than that will typically look to burn a lot more and possibly swing for the fences. So that's not really our sweet spot. But we typically can get comfortable with up to 50% burn on MRR. So just to make it very easy, if you're generating, let's say, 100 grand of monthly recurring revenue, your burn is 50K. So that means your expenses are $150,000 a month and your revenue is $100,000 a month.
Mm-hmm. Got it. Thanks. And here I would like to make a little parenthesis on us on what we do is, at Hum, we find debt providers for companies, and Tamaya has its sweet spot and they're really good at what they do. But if you fall on either side, size, bigger, smaller, structures, burning more, have already raised a lot of equity, talk to us and we can help you find that Tamaya for that specific thing that you're working on. But a couple of follow-ups on your specific structure. Does it matter if clients are paying monthly or annually? Do you take warrants? And do you place a blanket lien on the company? Those were kind of three questions that just popped up.
Doesn't matter if they're paying monthly or annually. We look at accrual or gap finances. So that doesn't matter. Second question was warrants. We are truly non-dilutive, so we do not take like warrants, personal guarantees, board seats. There's no equity kicker of any kind. And we try to have an extremely transparent process and a transparent cost of capital. So various interest rates for the type of company you are and the type of revenue you're generating. So we'll land anywhere between 12 and 20%, typically 14, 15, 16%. At the end of the day, when you've paid fees, principal, interest, that's where we come out at. Sorry, remind me of the last question.
Like the lean.
Oh, yes. So we take a general security position on the company the same way you would if you got a bank loan. However, there's a couple things that makes us different than our competitors. So we don't have like a lockbox on the account that you collect customers' cash from. So we don't take cash directly from your customers. We just invoice you a payment. Invoice you and then expect a payment. We don't require access to like a Stripe account, for example, or any other type of payment system that you're running to collect cash. While we do have security against the assets of the company, we've never had a missed scheduled payment in the last 6 or 7 years of any of our portfolio company in any month. We are not in the business of operating companies. We are in the business of doing loans. So we will do everything we possibly can to help our companies, our portfolio companies, work on their own. We do not want to get involved.
Well, I may say that maybe you're not taking enough risk. No, I'm just kidding. But
actually, I agree with you. There have been deals that we've passed on that I wish we did, but sometimes companies, have things that we kind of get uncomfortable with. So, for example, churn.
Mhm.
The company's churning a little bit too much. That's kind of like a veto for us. We might have to veto even though the rest of your metrics look really good. That's not a bad thing. You can work on that 3 months, 6 months later, come back to us, right? So
Awesome. Thanks. I wanted to switch a little bit back to kind of the forecasting, capital sources, and this is for Mike or Rick. Some pointers, maybe, how do you think about liquidity, right? Like, I'm assuming all of these companies are either burning, right, or are going to burn with this dead capital, right? You're going to use it for some expenses or a distribution or something. Or do you have any rules around, hey, how much liquidity do I always want to have at the company? And how to kind of connect the forecast to that, to debt or any other, capital infusion.
I'll take that first. So it's hard to sort of apply any specific rule, but I think it really does depend on the stage of the company. So I've been in some very early stage, 3, 4 employees, and you didn't know where the next month was coming from. And that's okay if the people on the bench have some equity and they're in the tent and they're there for the long haul and they're doing everything it takes to get things going to the point where you can scale or get to scale in the revenue. And I've been in the the 50-person company where you need your 6 to 8 month minimum cash flow if all the revenue falls apart scenarios, right? And you're always running those scenarios. And the bigger you are, I think the longer roadmap you need of where you're going to get your capital if your revenue falls apart. So again, no specific rule. Every business is going to be different. In my public sector business, the one I just sold, it was an annually paying customers with very large recurring revenue, 400 or 500 grand a year. So, we didn't get the monthlies on that. So we had some pretty chunky months. We were seasonal as well with some of the way that the contracts work when governments had money. And we always were we had months with, where we just had to scrape through, but then we were flush. And honestly, I think the larger you are, the bigger those holes can be on some of that execution risk. So I haven't found the formula. But again, having a funder like Tamaya, and others, when those needs emerge, right, that's where you tap your partners.
Got it. Rick, anything to add on that?
I'm similar to Mike in that I don't think there's a perfect formula out there, but I do have some loose guidelines that I follow. And I referenced it earlier when COVID hit, and that is cash coverage. I'm not. It's quite a bit different than a burn ratio, because I find burn very difficult to plan for, because you have multiple variables that you're looking at, and just keep it revenue and expenses. You have to take both into effect, right? So I use cash coverage, and cash coverage is simply a multiple of required expense burn that you have. And if you have, here's some caveats, if you have a recurring revenue business, then I believe you can have a lower cash coverage. If you have one-off, and this wouldn't be quite the right audience for this webinar, but if you have uncertain large contract or even small contract type businesses that aren't recurring, then you need to have a larger cash coverage, because your revenue side is more uncertain. So if going back to cash coverage, if my outlook is uncertain, i.e. during COVID, then I'm going to have a higher cash coverage. I have, for a recurring business, I've done that at 3x. When times look pretty rosy and we feel emboldened by our business, then I'm going to take that down as low as 1x cash coverage. And it's really interesting when you look at cash coverage versus your forecasting and your cash burn, because 1x cash coverage can actually equal a full year of burn in some cases, just depending on how you line them up. So those are the two that you can play with and compare.
And just for me to kind of to understand it, when you say cash coverage, it's basically 1 month of expenses taking out all revenue. Is that, or any payments, right? Or any money coming in? Awesome.
1x cash coverage is remove all revenue, just look at your expenses in a month.
Awesome. Thank you very much. I think it's time to open it up for Q&A if we have any questions, from the audience or whoever's listening to us. I don't know if we can open that up. I guess I have a question from the audience. To Mike and Rick, how much did you know about non-dilutive financing when you started running your companies? Like, did you have experience with this or not, or how did you start on this?
So for me, it was something that emerged. There was a couple companies. Again, I spent a lot of time in the Salesforce ecosystem, which was, for the last company was almost 11 years. So I was in that ecosystem. And it sort of emerged probably, I want to say 8 or 9 years ago from today. There's a few early entrants. And then Greg Smith lent me money twice at his prior company. and then ultimately again at Tamaya. And I think now, probably as of about 3 or 4 years ago, it seems like it's fairly pervasive. And I think there's a lot of options. So I ran into it once, didn't think of it at the time, didn't need it, but then when I needed it, seemed like there's a lot of options. And for I'm a Vancouver-based company, so for me, Tamaya was a logical choice, and I had done business with Greg before, so that worked out well for me.
Yep. From my experience, I knew absolutely nothing about non-dilutive capital. I was wholly focused on the equity side of things and just didn't think that debt funding was even an avenue, because you had such a wide spectrum, meaning on one end of the spectrum, I could have gone to the banks, but I couldn't go to the banks at sort of 6 to 8% for technology company. Just didn't have the revenue or the history. And then on the other side, it was 50% plus, and that certainly wasn't an option. So when I found, and it was a competitor of Tamaya, when I found this option, I knew absolutely nothing about it, and it just made a lot of sense.
I have a couple other questions. One that I missed earlier is for Mark. What is the thought around covenants with you? And how do you assure that your debt is good if the company starts to have a hiccup?
Sure. So we are relatively covenant light. We're quite transparent about that, about each of our covenants. An example of it I already mentioned is the burn covenant. So we put that in as a reflection of the types of companies we're trying to target. We're trying to target more capital efficient companies that aren't swinging for the fences. We do have a couple of others, but they're very light. Again, we want the company to operate its growth plan, and we want to stay out of the way as much as possible.
Awesome, thanks. And I got a question, I guess, for me and you. What's the difference between Hum and Tamaya? And I'll take that one. We're a marketplace for debt and equity. I don't work on the equity side, but we're a marketplace for debt, and we basically try to find, the best 3 to 5 lenders for a company. We do that with our technology. We extract information from QuickBooks or other accounting systems, and that generates, some analytics, some ratios, some information, and then it generates a pool of possible lenders. And then my job is to kind of go and make sure that makes sense. And then we send introductions to those lenders. And so, through us, we can send you along to Mark if that's the case. But, if there's companies, we handle all kinds of different companies. So, traditional businesses for banks, lenders, we can even do lenders, warehouse lines, etc. But that's kind of what we do. That's the difference. Do we have any other questions?
Yeah, Eduardo, I have a couple things to comment on here. So, from your previous question, I actually did not know anything about non-dilutive capital, especially revenue-based financing, when I learned about Tamaya in 2018. I've been in the B2B SaaS space officially since 2012. And I've worked for various different B2B SaaS startups based in Canada and in the US. And when I worked for that first one and I found out about monthly recurring revenue, everything just clicked. It's like, why would you not build a business that has monthly recurring revenue? You get predictable revenue coming in. You can start opening up more opportunities. And as Rick mentioned, you can have less cash coverage. So I thought that was amazing. And then I found out about revenue-based financing in about 2018. And it was interesting to me because you could then have an advantage of, let's say, taking on a little bit of equity and taking on a little bit of debt. And so you reduce your dilution, but you still get to operate your plan. And so I started researching all these RBF lenders at the time. And, there back then, there wasn't a lot of players. Tamaya was one of the first ones. Ledger Capital was there. There was a bunch of like family offices or like very large VCs and private equity that would provide debt alongside as well, right? So it'd kind of be both. And so the one thing that I would encourage is that every business is very unique. And now there are hundreds of lenders in this space. And so if you don't know exactly who to go to, having someone like Hum identify, here's the 5 players you should talk to, is beneficial. We're talking to a different company at least once a day, quite often more than that. And we don't like to waste anyone's time. So if you can save time, if you can just get to those 5 people you should talk to, and then talk to people like Rick and Mike who've been through the process already to learn what these lenders are like, I mean, that is a much, much more streamlined process.
Yeah, no, couldn't agree more. And I'm just looking at the time and no more questions are popping up. So, any closing remarks, Mike, Rick, the floor is yours.
I have just one thought, and it grabs onto the idea of communication, Mark, that you were talking to in terms of building a short list and talk to as many people. It also correlates with what you were saying earlier, Mike, around practice your pitch as many times. So this idea of communication is really important. And I'm going to laser in on one piece of communication that often entrepreneurs, including myself, have forgotten about along the way, and then you refined it.
Like I said before, as a CEO, where your job is to make sure you're financed and, all of that, there's a lot of legwork. And I've often thought, if there was a place that just kind of assembled all of that and I could just give my financials and that went out, like, as long as you're okay with that information going out to a pool, that seems like to me something to shortcut the process and, takes a burden of time, right? If you can find a partner that, as a leader of the company, that improves your burden of time spent on something, that's highly valuable, because that's time you can spend on your team or your coaching or doing something in the business, or working on the business, depending on what your needs are. So that seems like a new emerging type of facilitator in the space that maybe didn't exist before. An aggregator, I guess. And there's value in that, I think, as a business owner.
That's great. That is kind of the mission. But yeah, thank you. And Mark, before your closing remarks, one thing that I wanted to share is lenders don't like surprises, especially bad surprises. So, most lenders are going to be with a company for a while, and so I always stress on companies, be transparent, because when a hiccup comes along, like Rick mentioned, but I'm assuming Rick and his company was very transparent with Tamaya. Tamaya is willing to listen and be patient. If it's a negative surprise, they're probably not going to be as excited if the company tried to hide something, right? But anyways, Mark, any closing remarks? And Rick, if you're back, take it away.
I am back, and that's exactly the point that I wanted to make, EG, which is be transparent in the spirit of communication. actually build it into, at minimum, your monthly cadence. We've talked a little bit about different cadence and process as you're building your company, and that cadence of once a month at minimum to talk to your lender or equity folks to tell them how you're doing and what's up is a really, really important communication tool that you should be using. And it breeds flexibility and patience for when things get challenging.
Awesome. Mark, any last comments?
Sure. Just one last comment on that, because I think people here will appreciate. We know as a lender, and we've seen that things don't always go to plan, and that's fine. But we've got a strong mix of talented individuals here at Tamaya, from previous venture capitalists to strong finance people, to entrepreneurs, previous entrepreneurs. If we see those things early, which we tend to do, we can find ways to help that company get through it, or move to the next chapter in their journey. So we've had companies with us that, either, it's a tired founder, been at it for a long, long time. Maybe it's a company that's kind of gone off track. Maybe they haven't found product market fit, or maybe the market's changed. We can find ways to help those companies have a positive next chapter. And we're happy to do that. So in closing, I don't know, I guess, EG, thanks for having us here. Rick, Mike, I appreciate your time. I know that, it's been a while since you've been in the Tamaya portfolio, but it's just nice to hear the story again. I think that's the best way we can support the community. It's important, I think, at this stage, even though if you're in the bubble of SaaS, you feel like it's mature, but in the big scheme of things, I don't think we're there yet. And I think it's important that we support founders through their journey and all their stages. So yeah, thanks.
And thank you, Mark. Thank you, Mike and Rick. I really appreciate this. I learned a lot. It's super exciting to listen about, different companies, different success stories, different not so successful stories. But, it's a small world, and we keep bumping into each other. So thank you for anybody or everybody that listened in or saw, checked out the video. Have a great rest of your day.
Yep.
Thank you, folks.
Bye.